Jeremy Grantham is known as a legendary investor. He's Harvard educated. His investment company manages over $100 billion of assets, and his own personal net worth is in the region of $1 billion. Now, Jeremy's in the camp of a growing number of investors who are all saying a stock market crash rivaling 1929 and 2000 is ready to hit at any time. In fact, Jeremy believes this is a super bubble event which only happens about once every 100 years, where we'll see the S&P 500 crashing down at least 50%. And if this were to happen, the Nasdaq would crash even harder, and crypto would see a crash similar to what happened in the last crypto winter. Not nice. So, some really important things to cover, and in this video we'll be looking at this super bubble event that Jeremy is warning about. Then we'll take a look at the two major warning signs on how to spot a major bubble just before it crashes. Then what investors can do. And then we'll finish with a bit of a bonus clip as Jeremy Grantham shares his thoughts for the first time on the crypto market. As always, if you do enjoy anything in the video, then drop a like. Always appreciated. Okay, so recently I covered why Cathie Wood believes we're going to see huge growth in crypto and stocks over the coming years, but it's always good to keep an open mind and look at opposing opinions. So, ready? Let's do this.
A standard bubble we defined over 20 years, perhaps 25 years ago, as a 2 sigma statistical event. It's just a measure of how much of an outlier you are. So you have a historical
deviation from trend.
Yeah, you have a price series of the S&P. You can calculate a trend. Statistics 101 is not difficult, and you can work out how far away from trend you are. And a 2 sigma is the kind of deviation that should occur every 44 years. And because we're a little wilder and less efficient than we should be, it occurs every 35 years. It's not bad.
We meaning human beings,
we being,
as a species.
As a species. Every 35 years. It was a little closer than I expected back then. But every 35 years feels about right. 1 a career, twice a lifetime. That feels like a pretty decent definition of a bubble. And a 3 sigma should occur every 100 years. Now we, as I like to say, we do crazy pretty well as a species. So they occur much more, 2 or 3 times more often than they should. They're out of kilter much more than 2 sigma. So 2 sigma, you can have some fairly standard bubbles. They give you a certain amount of pain, 30, 40, 50% pain. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now.
So, Jeremy believes we are in 3 sigma territory, which should only happen about once every 100 years, and that he's now almost certain that it is going to happen. As he's known as a bit of a bubble expert, he says there are distinct warning signs that we can look out for. So, next up, we'll take a look at these warning signs which occur right before a major crash, similar to 1929 and 2000. Take a look.
And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ.
So I heard two things to look out for in a super bubble event. Number one, an acceleration phase. This is where the market gains become far greater than the average. And then number two has to do with the small caps. And this is where the small caps begin to detach from the large caps. So let's take a quick look at some examples. So the first thing he mentioned was this acceleration phase. So let me just take you back in time and we're going to look at the year 2000. This is the dot-com bubble and then huge 80% crash that followed. So what he's basically saying is that leading up to it, so this starts in 1997, is that it begins to pick up pace and it begins accelerating and everyone's beginning to make huge gains. And you can see just before the year 2000, we had this huge exponential run and everyone begins laughing at the people that say that stocks are in a big bubble because everybody's beginning to get sucked in. Greed is taking place, and then we all know what happened. It went on to crash 80% over a 2 to 3 year period. And then the second thing he mentioned was about small caps beginning to detach from large caps. So let's just take a quick look. So here we have the Russell 2000, which are all the small caps in the US, and we'll compare it against the S&P 500, SPX. So in the past 1 year, small caps are down 10%, and the large caps, S&P, is up 15%. So there is the detachment that he's talking about. He's saying that smaller caps in a bull market should be growing faster than the large caps. Small caps are down 10%, while the large caps have been pumped up 15%. So what about a bigger time period? Let's just look at the past 5 years. So as we know, US stocks have been in a huge bull market and the small caps did 46%, where the large caps, S&P, did 91%. So large caps massively outperforming. So again, this backs up what he's saying. He's saying small caps should outperform large caps in a bull market. Now, the only other reason I could think of why this could be happening, which has to do with broad-based index funds. As retail investors become to get more educated, more and more people are plowing money into broad-based index fund. And the most popular is the S&P 500. So is the reason why the S&P is outperforming more to do with index funds than it is true fundamentals? Just something to bear in mind. Okay, so next up, I do like the fact that he doesn't just state the problem without offering a solution. So whether you agree with this or not, this is what Jeremy Grantham believes investors should do.
to tell investors they should sell. Should they?
As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced.
So he believes going 100% in cash would be a good idea, but it's also very hard to do. So he also recommends that investors look at emerging market stocks as well. And in particular, it's value-based stocks in the emerging markets. And interestingly, I do like to keep a track of the billionaire portfolios and what they're up to. And Ray Dalio's most recent update was also very interesting. His most recent portfolio changes included ramping up emerging market stocks. And in fact, the three largest positions right now are all emerging market ETFs. So clearly, he's on the same page. Okay, and to finish up, a bit of a bonus clip as Jeremy now shares his thoughts on the new sector causing a ruckus in the financial markets, and that is crypto.
I have spent a lot of time in the last year on cryptocurrencies. They may not be good for buying groceries. They may not be a store of value. They may be highly correlated with the speculative stocks. They may have come down 40, 50% like the specs, but they do something way over my head to understand.
Do you buy the argument that there is an important difference between Bitcoin on the one hand and at least a couple of other cryptocurrencies on the other? And I'll name them. Ethereum, that's a blockchain, Ether is the coin, and Solana. And the difference, and I'll do my best to articulate it, is that those other blockchains are actually building blocks for new businesses that will prove to be revolutionary because they will eliminate things or help to eliminate things that I suspect you don't like. Transactional friction in the banking system and rent-taking that remains embedded in legacy financial institutions.
So the question is there a technology, blockchain, that will turn out to be very useful, whether done by corporations and governments and everybody else? I am sure the answer is yes. There's a useful technology, et cetera, et cetera. Does this justify trillions of dollars of perceived wealth? No, it doesn't.
It might amount to trillions of dollars of wealth, eventually.
If they can find a usefulness for it when it's integrated into the economy, it will perhaps facilitate productivity, like many ideas do. Very few ideas of that kind floated around and were capitalized at trillions of dollars, even though they had an enormous impact on the economy. Blockchain should be like one of those.
Jeremy Grantham is known as a legendary investor. He's Harvard educated and has a net worth of around $1 billion. He believes we are in Three Sigma super bubble territory, which should only happen about once every 100 years. He says there are two main warning signs of a bubble about to burst, and that is the acceleration phase, when stocks begin to outperform and run way above average, and number two is when the small caps begin detaching from the large caps. He believes moving into cash would be a good idea, or taking a look at value-based emerging market stocks, as they're as cheap as they get right now. And although not a raging crypto bull just yet, he does concede that crypto does do something that's way above his head, but he thinks it still shouldn't justify trillion-dollar valuations. So, there you are guys, hope you enjoyed. What do you think about Jeremy Grantham's warning? Is now the time to exit the market? Let me know below. For me, this is why I'm not 100% all in on crypto or stocks, and why I do like to keep a healthy cash position. As even I can see the stock market has grown so much in recent years, it is looking a bit unsustainable. But for now, just to say, if you did enjoy anything in the video, then drop a like, and a big thank you to everyone who does. If you haven't yet subscribed, click below and join us. Got some great videos coming up that you don't want to miss. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.